Nike is a company that all of you have heard of, and most of you probably have some sort of Nike clothing at home. But if Nike is such a great company, why are they down by 13.24% over the past 5 years and down by 10.19% over the past 6 months? And that is something I want to focus on today and see if Nike is set to have a turnaround and start rising in price over the next years, or if they are set to become a dying star. Now, the main reason why the company is sinking in the first place is the growing concerns over increased competition from emerging sportswear brands, mainly in China. And this is also reflected on Nike's revenue growth, which has been decreasing quite drastically over the past 7 quarters. We can see that it went down from 17.2% to 14% to 4.8 to 0.6, 0.3, and in the most recent earnings call to negative 1.7%. So is Nike set to rebound or not? Well, to figure that out, we'll jump over to our stock valuation spreadsheet, where I will simply plug in the ticker NKE for Nike, and all the metrics will show up automatically. Now, of course, if you want to download these spreadsheets, you can do so at my Patreon in the link in the description. Now, as most of you probably know, Nike is a dividend-paying company. They currently have a dividend yield of just under 2%, and they have a dividend payout of $1.48 per share per year with a trailing free cash flow payout ratio of only 35%. Now, this is the first metric I want to focus on, the trailing free cash flow payout ratio. Normally, investors would look at the trailing payout ratio, which is the payout ratio deducted from the net income of a company. But as the dividends of a company are paid from its free cash flow, so using the free cash flow payout ratio gives me more clarity over the company's financial health. Currently, Nike's free cash flow payout ratio is sitting at 35%, which means that they can use 65% of their free cash flow for share repurchases, paying down debt, or overall developing the company, for example, innovating new designs or opening new shops. Now, to actually figure out whether a company would be a good investment, I use the 9-pillar analysis, which are the 9 most important metrics every investor should consider before opening a position in a company. So we will move to the first pillar, and that is the 5-year PE ratio to be sitting below 22. And this metric basically tells me the price of the company, whether they are cheap or expensive relative to their earnings. So if the company's 5-year PE ratio is below 22, it would mean that they are quite cheap. The 5-year PE ratio of Nike is currently sitting at almost 30, which is quite higher than the value we'd like to see. So that would be a cross for Nike. But things aren't actually all that negative. As we can see, the current P ratio of Nike is sitting at 23.16. And if we have a look at the graph below, we can see that the PE ratio has been decreasing over the past 5 years, going from about 36 in 2019 to 23.14 in 2023. So if Nike carries on with decreasing their PE ratio within the next year or two, we might see Nike trading at a cheaper, more approachable value. Now, as I am a value investor, before purchasing any company, I like to figure out the intrinsic value of that company. And to do that, I have my 4 valuation models, and the first one of these valuation models is the Graham's formula revised. And here we take the earnings per share of the company, the base PE, the 5-year growth estimate, the growth rate multiplier, and the average yield on A corporation bonds, and the current yield on the A corporation bonds, and get an intrinsic value of only $34.28, which is 136% lower than the current trading price of Nike, which tells us that based on Nike's earnings per share, the company is currently greatly overvalued. Now, jumping to the second pillar of the analysis, the price to free cash flow over the past 5 years to be below 21. And we can see that this is actually sitting at almost 60, which is drastically higher, almost 3 times higher than what we'd actually like to see. Now, unlike the PE ratio, which has been decreasing over the past 5 years, the price to free cash flow is actually increasing by about 21.17% per year. So this is a big fat red cross for the second pillar. Now, jumping to the third pillar, the revenue growth over the past 5 years. As we can see, the revenue has been growing, but as I said at the start of the video, the revenue growth has been decreasing on average. So we can see an average revenue growth of 6.25% per year, but the year-over-year revenue growth is actually sitting at negative 2.63%. But as the metric asks for revenue growth over the past 5 years, which has been happening, Nike has grown their revenue from 37.5 billion in 2019 to 51.4 billion in 2023. Nike gets a green tick for this pillar. Now jumping to the fourth pillar, which is the net income growth over the past 5 years, very similar to the third pillar, except here we look at the net income. And again, the same story, the net income is growing, but the growth rate is decreasing. Year-over-year net income growth is sitting at negative 7%. But the company did grow their net income, so this is again a tick for Nike. Now jumping to the fifth pillar, the free cash flow growth of the past 5 years. The free cash flow of the company is rising from 1.4 billion in 2019 to 6.6 billion in 2023. Though again, the growth of the free cash flow is decreasing and is currently sitting at about 0% year-over-year growth. Now jumping to the second intrinsic valuation model, the discounted cash flow model. And here we plug in the free cash flow over the past 5 years and figure out the average growth to be sitting at 86.56%. Now, such a huge growth number is because of the huge growth from 2020 to 2021. But as we saw, the average growth isn't that high, and the analysts project a growth rate of about 2.14% over the next years. Now, based on the research I did in the backend, I will calculate a growth rate into the future of 3%. Now, using this growth rate, I will calculate the future free cash flow. Now, to figure out the present value of that future free cash flow, which is the future free cash flow accounting for inflation, I will plug in a discount rate at 8% based on the WACC of the company and calculate the present value. Now I will sum up all of that future free cash flow, add any cash and cash equivalents, subtract total debt, and get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $109.79. And this shows us that even if Nike was to have very low free cash flow growth, the intrinsic value of the company would still be higher than the current trading price. But now let's jump to the sixth pillar of the analysis, and that's the 5-year profit margin to be above 15%. And again, it seems like Nike will be getting a cross for this pillar. Their 5-year profit margin is sitting at only 10.72, with their current profit margin sitting at 10.60. We can see that the profit margin has been fluctuating over the years, going slightly higher, going to 12.86% in 2020, which still isn't higher than 15% than what we want to see. So Nike gets a cross for pillar number 6. Now for the third intrinsic valuation model, the multiples valuation. And here we'll compare Nike to its competitors DEC, SKX, and Crocs. So we will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We'll then average out these PE ratios to get an average PE of 19.59 and multiply by the earnings per share of Nike to get an intrinsic value of $68.36, which really shows us that Nike is indeed doing worse than its competitors. Now moving to pillar number 7, which is the decreasing shares outstanding. And as an investor, you always want a company to have decreasing shares outstanding. In other words, you want them to be buying back shares. And this means that you will own a larger percentage of the company with years to come. And here we can quite clearly see that Nike has been repurchasing shares. In 2023, the shares have been sitting at about 1.5 billion, and now they're sitting at only 1.2 billion. They've repurchased almost 20% of the shares outstanding, which is phenomenal. On average, we can see they have been repurchasing about 4.7% of their shares, so Nike gets a green tick for this pillar. Now moving to the 8th pillar, the consecutive dividend growth. And with every dividend growth company, we want there to be consecutive dividend growth, which will allow for that sweet dividend snowball effect. And we can see that Nike has been increasing their dividends over the past 5 years quite clearly. But again, we can see that the dividend growth has been decreasing, increasing by 12% in 2020 and only by 2% in 2024. But as Nike does have consecutive dividend growth over the past 5 years, we will give this pillar a tick. And now moving to the fourth and final intrinsic valuation model, the dividend discount model. And here we will plug in the dividend payout of the past 5 years and calculate the average growth to be sitting at 8.65%. Now, as we saw in Pillar 8, the growth has been decreasing over the past few years. So I will project a growth rate of only 4% into the future. And by doing this, and plugging in the discount rate at 8%, the same discount rate we plugged in at our free cash flow model, I will get an intrinsic value of $37.7, which is again a lot lower than the current trading price. But moving to the ninth and final pillar of this analysis, the long-term liabilities of the 5-year free cash flow negative dividends to be below 5. And this is probably the most important pillar of all 9 pillars, as it tells me as an investor that the company has enough free cash flow to pay all their dividends and to pay off all their long-term liabilities so that they don't go into more debt. We can actually see that they have been decreasing their long-term liabilities from about 15 billion in 2019 to 13 billion in 2023 by about 2.3% every single year, so that is great as well. And when we combine this with the 5-year free cash flow payout ratio, which is sitting quite low as well, we can see that Nike really has enough free cash flow to pay for innovation, to buy back shares, to pay off their long-term liabilities, as well as raise their dividend. But now let's move to our ultimate valuation. And here we will average out the 4 valuations we did, and we will get an intrinsic value of $62.54, which is 22% lower than the current trading price of the company. And as it is currently quite uncertain where Nike will go in the next few years, I will plug in a margin of safety of 15%, so we will get an acceptable buy price at $53.18, which is about $27 lower than the current trading price of the company. Overall, it is not looking great with Nike. Their intrinsic value is lower than their current trading price, their growth is decelerating, and they still seem to be quite expensive based on their earnings and free cash flow. On the other hand, they are a well-established company with low debt and enough free cash flow to possibly overperform its competitors if they set out in the right direction. Now, personally, I'm not buying Nike stock right now. I will be waiting and watching as it drops lower in price. And when I see it hit my target, that is where I will buy the company. And with that, if you did enjoy the video, make sure to leave a like and subscribe as it really helps me out. Also, make sure to download these spreadsheets if you find them helpful and let me know down in the comments which company you'd like me to evaluate next.